This framework explains how a U.S. resident can work toward a consistent five-figure monthly income without using interest-based products, debt yield strategies, or speculative shortcuts. This is not a promise, not a forecast, and not a guarantee. It is a structured operating plan built on real U.S. market mechanics, verified business models, and income paths that are permitted under standard ethical business rules. The focus is execution discipline, cash flow control, and repeatable value creation. The number 10,000 is used as a benchmark for scale, not as an assumption of outcome. The first principle is understanding that monthly income at this level is rarely a single activity. It is usually a system of 2 or 3 income engines that compound operationally, not financially. Each engine must produce real value, generate cash from customers, and avoid dependency on borrowing, yield products, or passive interest exposure. The plan is divided into phases so that income grows in layers rather than in fragile leaps. Step 1 is stabilizing a base cash engine. This is the non-negotiable starting point. A base engine is an activity that reliably produces between $2,000 and $4,000 per month in the U.S. market, within 6 to 12 months of focused work. Examples include specialized service contracting, operational consulting for small businesses, logistics coordination, compliance assistance, bookkeeping without lending exposure, or technical implementation work. These are not trends. They are demand-driven services supported by small business administration data, showing consistent spending by U.S. small firms on outsourced operations. The key requirement is skill specificity. General services fail. The process begins by selecting one operational problem that U.S. businesses already pay to solve. Examples include payroll setup without credit products, inventory tracking systems, vendor onboarding workflows, or cost control audits. Research is done by reviewing job boards, local business associations, and vendor marketplaces to identify repeated pain points. The service is then defined narrowly, priced clearly, and delivered personally at the start. Income at this stage is active and time-bound, but it builds credibility and cash stability. The goal is not scale yet. The goal is proof, testimonials, and operational clarity. All revenue is kept liquid. No reinvestment into yield products or financial instruments occurs. Step 2 is converting labor into systems. Once the base engine is stable, the next phase focuses on removing the income ceiling. This is done by standardizing delivery. Every service is documented as a repeatable process. Intake steps, execution steps, delivery timelines, and quality checks are written clearly. This allows delegation without loss of control. At this point, subcontractors or part-time assistants are introduced. They are paid per task or per output, not per hour, which aligns cost with delivery. This structure is widely used in U.S. professional services firms and reduces fixed overhead risk. The owner remains responsible for sales and quality, while execution becomes modular. With systems in place, capacity increases without increasing personal workload at the same rate. Monthly income can now move toward $5,000 to $7,000 based on volume rather than personal time. This growth is operational, not financial. No leverage is used. All expansion is funded by collected revenue. Step 3 introduces a second income engine that is asset-light but margin-focused. This engine is designed to stack on top of the first without operational conflict. Common examples include white-label service partnerships, compliance documentation services, industry-specific data reporting, or recurring support retainers. The defining feature is monthly continuity. This step requires identifying existing clients from the first engine and offering an adjacent solution that solves a related ongoing problem. For example, a business that receives operational setup may also require monthly reporting, vendor coordination, or regulatory updates. These are charged as flat monthly fees. Research from U.S. accounting and consulting associations shows that recurring retainers stabilize cash flow and reduce sales pressure. The objective here is predictability. Even modest retainers multiplied across clients create reliable monthly income that compounds through volume. At this stage, the combined engines can approach $8,000 per month when executed consistently. The work remains ethical, service-based, and grounded in real demand. There is still no reliance on interest, spreads, or speculative appreciation. Step 4 focuses on efficiency and pricing power. This is where many operators fail by chasing new ideas instead of refining existing ones. Pricing is reviewed based on delivered value, not time spent. Clients pay for outcomes and reliability. Underpriced services are adjusted gradually with clear communication. Operational waste is removed. Tasks that do not increase revenue or client satisfaction are eliminated. Tools are selected carefully, prioritizing fixed cost control and data security. According to U.S. small business efficiency studies, margin improvement often contributes more to income growth than customer acquisition at this stage. Step 5 is introducing a scalable distribution channel that does not depend on attention-based platforms. This can include partnerships with industry associations, referral agreements with non-competing firms, or placement on vetted professional marketplaces. These channels provide inbound demand without constant personal outreach. Each partnership is structured with clear terms and transparent fee sharing. No referral involves financial inducements tied to lending or yield products. All compensation is service-based and disclosed. As volume increases, monthly income can cross the 10,000 benchmark through combined base services, retainers, and partnerships. This is not sudden. It is the result of layered execution over time. The final step in this phase is financial discipline. Revenue is allocated deliberately. Operating reserves are built. Taxes are planned using compliant deductions and entity structures appropriate under U.S. law. No funds are parked in interest-generating accounts. Liquidity is maintained for operational resilience, not return chasing. This plan works because it aligns effort with market demand, avoids fragile financial engineering, and prioritizes control over growth speed. The focus is not shortcuts. The focus is building something that produces value month after month through work, systems, and trust. This second phase explains how the 10,000 monthly income structure is protected, stabilized, and made sustainable without introducing risk mechanisms that undermine the system. Reaching a number is meaningless if the structure collapses under stress. The objective here is durability, clarity, and long-term control. The first focus is workload insulation. At higher income levels, the greatest threat is not competition, but burnout and operational overload. Every core task must have a documented backup process. Client communication templates, escalation rules, and delivery timelines are standardized. This ensures that no single client or task can destabilize the system. U.S. professional services data shows that firms with documented operations experience fewer revenue disruptions during personnel changes. The second focus is client concentration management. No single client should represent more than 20% of monthly revenue. If one client crosses this threshold, new client acquisition becomes a priority until balance is restored. This reduces dependency risk and preserves negotiating power. Income stability improves not by adding complexity, but by spreading exposure. The third focus is legal and structural clarity. The business entity structure is reviewed to ensure proper separation between personal and operational finances. Contracts are updated to define scope, payment terms, and termination conditions clearly. This reduces disputes and accelerates collections. Clear documentation is one of the most overlooked income protection tools in the U.S. service economy. The fourth focus is cash flow timing. Monthly income figures often ignore when cash actually arrives. Payment schedules are aligned to ensure steady inflow throughout the month rather than end-loaded collections. Retainers are billed in advance. One-time services require deposits before work begins. This protects working capital without borrowing. The fifth focus is cost discipline at scale. As revenue grows, unnecessary subscriptions, tools, and services quietly accumulate. Quarterly expense reviews eliminate low-value costs. Every recurring expense must either reduce time burden or directly support revenue. This habit alone can preserve thousands of dollars per year in net income. The sixth focus is reputation reinforcement. At higher income levels, reputation becomes a compounding asset. Case studies are documented. Client feedback is requested formally. Professional credibility is strengthened through transparent results rather than marketing noise. Referrals increase naturally when delivery quality is consistent. The seventh focus is controlled expansion. Expansion does not mean new industries or unrelated services. It means deeper penetration into the same value chain. For example, offering higher-tier support, faster turnaround options, or specialized compliance assistance. Each expansion is tested with existing clients before broad rollout. The eighth focus is risk filtering. Every new opportunity is evaluated against 3 criteria. Does it involve real value exchange? Does it rely on customer payment rather than third-party yield? Does it preserve operational control? If any criterion fails, the opportunity is rejected, regardless of potential revenue size. The ninth focus is skill upgrading. Income durability depends on relevance. 1 skill per year is upgraded intentionally based on market demand. This could include regulatory knowledge, technical tools, or process optimization methods. Learning is targeted, not scattered. The 10th focus is exit optionality. Even if an exit is not planned, the business is structured as if it could be transferred. Clean records, documented systems, and stable client contracts increase optionality. This discipline improves current operations even if no transfer occurs. The 11th focus is personal income separation. Owner compensation is structured clearly. A fixed monthly draw creates predictability. Excess cash remains in the business for operations and reserves. This prevents emotional spending decisions tied to revenue fluctuations. The 12th focus is compliance awareness. Regulations change. Staying informed prevents costly errors. This includes tax rules, labor classifications, and industry-specific requirements. Compliance is treated as protection, not inconvenience. The 13th focus is resilience testing. Periodic stress tests are run mentally and operationally. What happens if a key client leaves? What happens if a contractor becomes unavailable? Contingency plans are written and reviewed. Preparation reduces panic responses. The 14th focus is value communication. Clients must understand what they receive and why it matters. Clear reporting reinforces perceived value and supports pricing integrity. Confusion weakens retention. The 15th focus is simplicity preservation. Complexity grows naturally. Simplicity must be defended deliberately. Fewer services delivered exceptionally outperform many services delivered inconsistently. Simplicity strengthens margins and focus. The 16th focus is ethics consistency. Income that violates personal standards creates long-term instability. Consistent ethical alignment builds confidence and clarity in decision-making. This is an internal control mechanism. The 17th focus is patience. Monthly income stability develops through repetition, not acceleration. Systems mature through use. Trust compounds through delivery. Rushing expansion often destroys what was built. The 18th focus is review cadence. Monthly reviews track revenue sources, client health, and operational stress. Quarterly reviews adjust strategy. Annual reviews reassess direction. Reflection is structured, not emotional. The 19th focus is documentation ownership. Knowledge stored only in memory is fragile. Written systems preserve value beyond the individual. This is a professional standard. The final focus is perspective. 10,000 per month is not an identity, it is a performance metric. The real objective is control over income generation, without dependency on fragile mechanisms. When income comes from value creation, systems, and discipline, stability follows. This framework does not promise outcomes. It provides a map grounded in how sustainable income is built in the U.S. market, without reliance on interest-driven structures. Execution determines results.